Okay, in this video we are looking at the S&P 500 chart storm from the 6th of August. This is the weekly Twitter tweet storm that we do on the US markets and just try to include a range of very interesting and insightful charts. So let's walk through it and add a little bit of extra context and comments. The first chart here from Ivan Snurrer. And this shows historical bull markets, so the length of the market and also the overall gains across the period. And so if you're looking at the Dow Jones, the current one is ranked about 4th place at the moment, versus the S&P 500 is ranked 3rd place in the history of its big bull markets. Not very far from getting into 2nd place for the S&P 500, and but there's still quite some way to go before that 90s period comes into play. The second one is one of my own. So from top-down charts, if you're not following us, I think we've got the handle there. So yeah, if you're not following, you definitely want to be following that account. Especially if you enjoy the odd chart. So this one is what we call the euphoria meter. And this combines the forward P ratio, bullish sentiment from the AAII and II surveys, and the VIX inverted and smoothed, by the way. And this indicator worked extremely well in picking the market bottom in 2015, 2016, big reset on that. And since then, this sort of new bull market or renewed bull market has brought the indicator all the way back up to a post-crisis high. We're still not quite at the heady, euphoric days of the late stage of the dot-com boom, but as you get up to this level, what it says is that the expectations are increasingly higher, and when you have very high expectations, the risk is that you disappoint. And sort of an accompanying chart to that one, the Great Capitulation. So this is a big transition from neutral sentiment to bullish sentiment. So in the lead up to that 2015-2016 correction or market turmoil there, we actually had neutral sentiment running up to its strongest or highest readings on record, really. And this again is combined AAII and II sentiment. And again you can see that the bullishness dropped off to levels that you only saw at the beginning of some major bull markets there. So, and now that you've had this big reversion, what happens next is probably the key on this chart. Whether you actually get them to cross over and a full transition from neutral to bullish, and as the market moves higher, it'll probably drag people kicking and screaming into that camp. So, that's another one to keep on the radar. Number 4 is one that has stirred up quite a bit of controversy, actually. So this one, as I understand it, is the survey respondents' confidence that stock prices 1 year from now will be higher. And it's basically 100%. I'm not too sure about this one. I'm going to have to go and have a look at this one, because we did a survey to try and replicate this. I think I'll try and pull it up. Here we go. So we tried to replicate this survey here, and for the individuals, it's it's worse than 50% saying up, and for the institutionals, again, it's probably it's much less than 50% saying up a year from now. So either the people that are responding to this poll are uniquely pessimistic, or something's going on here. So we'll go and have a dig into that. Number 5 from J Lyons Fund Management. down the line. So very, very good follow there. So if you're not following him, definitely a good one to follow. A lot of good charts there. And this one is pointing out here that the AAII, that one popping up again, investor cash allocation from their survey has dropped to a lowest point since January 2000. So that's quite meaningful, really. It just shows you, well, I mean, technically there is still cash on the sidelines since it's sitting at 15%, but versus where it usually sits, it's certainly at the bottom end of the range. And number 6, one from Nick at FP, another good follow. So this one shows a table from Goldman Sachs which looks at the aggregate and median valuation metrics, the current and long-term average for the S&P 500. And no surprises there. I think if you're not aware that valuations are very high, then you probably haven't been paying attention. But again, this is just another way of showing how high they are and how high they are versus history. Number 7, I mean, the other side of the coin for valuations is earnings. And if the DXY, the US dollar index, continues to weaken, then that's going to be a source of upside, a tailwind for earnings. So that's one thing to keep in mind. Number 8, NYC margin debt. So this one's actually rolled over from the high in April. I mean, it's given a lot of sort of, I guess, false rollovers through history. But, when it rolls over sharply, it can be a bit of a more meaningful, considerable warning sign. If you look back at the dot-com boom, rolled over in a big way, but that was after, really surging. It's quite interesting, both of those market types, you saw a real big surge in the last stage. If you can call that there about a surge, maybe you can. But it's probably one to be aware of, and as a percentage of market cap, it's definitely up there as well. The one I like to look at is the second one, which is acceleration. And my rule of thumb for margin debt acceleration, which is just a year-on-year change, is that the warning sign is a really big surge, again, like you saw at the tops there. And then when it drops and goes all the way below the negative line, that's, that can be a big bear market warning when it does that. And it's done neither of those just yet. So, again, this is like, rather than looking at this chart, you probably want to look more at this one. And then the final one here is mentions of Trump policy in the earnings calls. And this is comparing the latest quarter versus the final quarter of last year. And, the final quarter of last year, Trump policy was absolutely front of mind for a lot of people, and especially companies. And you can see it there across various matters of importance, so tax policy, regulation, trade policy. You can see a massive drop there. And, part of that, I guess, is just, back at the end of last year, there was that uncertainty factor. There was also a lot of confidence that was sort of built into the market. This chart, by the way, is from FactSet. But, I guess if we've learned anything since then, forget clarity about policy. Probably the bigger clarification is that not a lot seems to be able to get done. So, people perhaps ignoring that, downweighting that, which, when you think about the positive or bullish aspects, such as tax reform, that could be a bit of a negative, a bit of a source of potential disappointment. But, I guess equally important is that some people are probably concerned about what kind of damage he could do. And arguably, I guess you could probably make a case that given how hard it has been for him to get anything done, maybe the risk of him, his ability to do damage is actually lower or less than maybe some people might have initially feared. So that's another angle to take on that one. Probably another thing worth mentioning, just since we're talking about markets and macro, is on the topic is over the weekend we've had the UN Security Council approving very tough sanctions on North Korea, and that's going to be probably, well, I think if you look at geopolitics, North Korea is probably one of the key risks, and tightening the noose like that is going to make things interesting there. Time will tell what kind of reaction that'll draw from them. If anything, it could be, encouraging them to take even more drastic steps, do more missile tests, maybe even do the much awaited, much speculated nuclear tests that had been on the cards for some time. So, in terms of the risk outlook, that's one that's probably, if anything, has been ratcheted up a little bit as a result of that. So I'll leave it there, and if you've got any other questions or comments or any queries about the charts, any requests for next time, do pop them into the comment section below in the YouTube video.